One thing I've learned in economics is never, ever underestimate the ability of self-serving governments to kick problems down the road instead of solve them. I mean, this problem has fundamentally come about because the governments of the world have run unsustainable deficits and have built up unrepayable debts, and they are trying to monetize those debts. So, if the question is when is this problem going to stop? When are governments going to stop spending more money than they take in revenue? When are they going to stop printing new dollars? It could go on for a really long period of time. They could keep interest rates very, very low for the rest of my career. Talking about whether commodity prices are manipulated and the trading and COMEX and all those types of things. I would say that, so I've recently been added to the board of the World Gold Forum. And I would say that it's very much on our attention and on our radar, understanding and changing how gold is traded around the world. And I would say stay tuned over the next number of years, because I think you're going to see a lot of structural changes that way.
Welcome back to Liberty and Finance. We have a duo of influential characters in the precious metal space. We have Rick Rule, director at Sprott. We also have Nolan Watson, the president and CEO of Sandstorm Gold Royalties, who's been with us before. Both of them have been separately, but never together in this format. Gentlemen, thank you both for coming on Liberty and Finance, this time together.
Pleasure.
Yeah, thank you.
We had a very interesting conversation with Keith Neumeyer of First Majestic Silver and Rick Rule. And in that, Keith brought up that Sandstorm was one of the companies that helped them in establishing some technology in a laboratory and so on. And it reminded me of, Nolan, when you and I spoke about the role and the relationship between royalty and streaming companies with the underlying mining companies that are doing the operations, in that it's natural and synergistic for the royalty and streaming company to support, cultivate, do anything they can to help ensure the success of the underlying mining company. So I wanted to kick us off with that kind of a discussion. If you could let us know, again, help people who are new to this, because these concepts are not necessarily familiar to most, what the relationship is between a royalty company and then the mining companies that are actually operating the mines and so on, so that people understand that relationship, and then how it is that royalty companies can help to make sure that of the success of the partnership, and that through that success, everybody wins.
Yeah, so I mean, the basic nature of the relationship between a royalty company and a mining company is pretty simple. It's that they mine their mine and they give us a certain percentage of their production or a certain percentage of the cash flow they receive for the life of the mine. There's no obligation for the royalty company to be involved in the operations of the mine, and certain, we don't even like doing that. But what I would say is that once we own that right to have a certain percentage of the production for the life of the mine, we're very incentivized to make sure that that mine is successful. And so when we look inside Sandstorm, we've got tons of geologists, engineers, and these are world-class people who have been working at an elite level for many years in the industry and have a wealth of knowledge and a wealth of not just expertise, but also contacts around the world. And so it's pretty normal that over time, the nature of the relationship evolves such that the mining company knows they can reach out to our technical guys and say, hey, do you know someone I can phone where I can talk about this metallurgical issue, or can I talk about this geotechnical issue? And our guys help make those connections, because it's in our interest to make sure that that mine is successful. It's actually not abnormal for our guys to go on site and sort of just do a general visit and then say, hey, have you ever thought of hiring a firm to add this part to your circuit to increase your production and increase your metallurgical recoveries? And we've done that a number of times now, and a number of the mines have made very tangible improvements to their own mines that have benefited them and us. And so it's a good symbiotic relationship.
Rick, it made me think about you talk about the analysis that you do looking at different companies. You look at their balance sheet, you look at their management team's track record, you look at a lot of things. Some of this sort of process effectiveness and technological innovation, that kind of thing, that's not necessarily jumping out of balance sheets. Well, maybe it does in the end if it has an impact. But what do you look for when you're wanting to make sure that you see that kind of relationship where, like, royalty companies are helping to build up or help the success of their related mining partners?
Well, certainly a successful company in any endeavor, I think, takes beneficial input from any source that they can get it from. I know certainly at Sprott, we do that. And to the extent that your company gets too insular, which is to say that you refuse positive input from stakeholders, as an example, a royalty company, which is a partner, that becomes a pretty easy decision for me. It's a sell. The adaptation of process and technology is ongoing, and it actually does reflect itself, and it reflects itself fairly quickly in the income statement, and then ultimately in the balance sheet. We care a lot about who our company's strategic partners are, about who the constituency is. So, I mean, even to the point where there are royalty companies and streaming companies or engineering service providers that are important to us, and others who aren't. So I would suggest that all of those so-called soft factors that you're referring to become reflected as hard factors very quickly. You do a sort of qualitative differentiation, which is to say, you look at the relationships that a company and its directors enjoys within the industry, and you use that as a predictor, because many, many, many more times than not, those qualitative issues become to have quantitative outcomes. We look too at the decision-making process. If a company does a royalty or a stream with Sandstorm, it's really a different form of equity. If the company believes that they can dilute at the project level with a royalty and a stream, because Sandstorm contributes disproportionately more capital in one way than the issuer does in return for getting an income stream that's unburdened by cost. The way the transaction is structured and the people with whom it is structured tell us a lot about the decision-making of the decision-making process of the management team. If they entered into a royalty agreement or a streaming agreement because it lowered their cost of capital and they understood it to lowering their cost of capital, this is an intelligent management team. This is a management team worth backing. And believe me, Donegan, you've heard me say this sort of intelligence that we look for is not ubiquitous in the mining industry necessarily.
That's true.
That was pretty gentle, wasn't it?
Very good.
I wanted to get a high-level take on one topic that I think a lot of people can relate to. A lot of people in general are watching the effect on many things of interest rates. People are considering whether or not to buy a new home based on interest rates. People are talking about whether or not the equities market, the stock market, will continue to rise based on interest rates. You're looking at the 10-year bond yield and say, gee, is this signaling that things are going to be continuing to be affordable, easy money policies if rates are lowered, versus things are going to get tight if rates go up? Rick, you've talked about the environment of interest rates, real interest rates versus nominal interest rates, and how it affects the precious metals price perspective, the whole bull market phase that we're in on precious metals. Could we talk for a moment about that? We have a question from Bernard M. Baruch, who says, Craig Hemke interviewed Chris Vermillion, commenting that higher interest rates, 10 years near 1.5%, were really weighing on gold. But Rick also pointed out that during the high interest rate 1970s, gold price rose some 7 times. So can we talk for a few minutes about the effect of interest rates on the precious metals and perhaps also on the mining industry as that's related? But Rick, why don't you kick us off, and then Nolan, whatever highlights that you can bring on that would be good as well.
The questioner's handle, Bernard Baruch, is interesting. That amuses me at the offset. I think that the most important total determinant of precious metals prices are real and nominal interest rates. I've been watching gold markets for 50 years now, and there's many things that move gold, most of them associated with fear. But the primary fear that moves gold markets is fear of the ongoing purchasing power of savings instruments, other forms of savings instruments, conventionally denominated in US dollars. And both real and nominal interest rates matter. And also the cause of the interest rate rise matters. In the 1970s, the interest rate rose really as a consequence of market action. And although the nominal interest rate might have been in the US 10-year Treasury 15%, it was still negative because CPI inflation, as stated, before it was hedonistically adjusted, was 19%, which is to say that even at a 15.5% yield, that the real yield relative to the depreciation of the purchasing power of the US dollar was negative, and hence gold was very strong. When interest rates began to fall, and I could go on, I'm going to give you the real short form of this.
No, this is really good because I want to grab one thing you just said. So we've had John Williams from shadowstats.com on, and he's talking about the difference between if you count the way they used to count in the 1980s, or if you count the way the Chapwood Index counts, which is what people are really buying, that we're really at a 6 to 10% consumer price index rather than the 1.6% or 0.75% for Social Security, whatever. So you've said for some time that negative real interest rates, in other words, if the real rate of inflation is higher than what you can get on savings or bonds, then that's an environment where dollars will be looking for somewhere to be treated better. I get you. Okay. I just wanted to catch up to where you were at.
Yeah. Yeah. So, I think that's the most important single determinant. When, people say to me, why has the gold price declined recently? I say, the gold price went up in a period where the US 10-year Treasury fell from 200 basis points to 60 basis points. Now the US 10-year Treasury has gone up from 60 basis points to 150 basis points, paralleling perfectly the plateauing and then the decline of the gold price. It makes absolute sense. One needs to one needs to speculate on where real and nominal interest rates go from here. My personal suspicion is that the interest rate rise on the US 10-year will begin to be mirrored elsewhere in the economy, that the 30-year fixed mortgage rate will go up, reducing affordability, reducing employment in the housing industry, that the rate on auto loans will go up, which will reduce auto sales, that the prime interest rate will go up, increasing the cost of capital for the largest companies in the United States and Canada. And more importantly, I guess, to the government, the interest rate they're charged when their short-term borrowings roll over will go up too, reducing their ability to afford the goods and services that are already constrained by budgetary constraints. I don't think, although I don't know, that they're going to make this interest rate hold, particularly given the incredible refunding that the United States Treasury needs to do for the balance of 2021. If I'm correct and the interest rate declines again, the nominal interest rate, I think that you're going to see gold go up. A very different question, and Nolan, I promise I'll cede to you in just a second. You can tell I'm fairly passionate about this. The difference between the nominal and the real interest rate really has to do with the extent to which the interest rate does or does not accommodate the deterioration of the purchasing power of the dollar, which is to see the CPI stated rate of inflation. John Williams, I think, is an absolute genius. I don't want to comment on what he does because I don't understand all of it. All I can say is that the people who compile the CPI don't shop where I shop. When they say that the purchasing power of my dollar is declining by 1.6% a year, although I'm an old cheapskate and I don't buy much, I notice as an example through building my house that the price of lumber increased 125%. It amuses me too that when it's inconvenient, they don't include food or fuel. As you can see, I eat. So I do have some problems with the way they calculate the CPI rate of inflation. But even if I didn't, their estimate, the Congressional Budget Office estimate of the deterioration of my savings is 1.6%. So I'm lending them money for 10 years at 1.5%. This is the first promise that my government's going to keep in my lifetime. They promised to give me back less money at the end of 10 years than I gave them at the beginning of the 10 years. In other words, I'm going to pay them to forego consumption I'm going to pay them to take credit risk, and I'm going to pay them to assume the risk of time value of money. Jim Grant calls this return-free risk. I mean, this is an absolutely silly value proposition. Sorry, Nolan, I really am, but this is something I'm passionate about.
It is. I mean, we're in historic territory here. I mean, the world has never had as much debt as it has right now. The governments of the world have never been in as much debt as they are right now, and they've been debasing their currencies as much as they can so that they can basically monetize their own debt. I mean, they need to get solvent themselves. And when they devalue their own currencies, asset prices denominated in those currencies go up. It's pretty straightforward. And those assets can be gold, they can be copper, they can be houses, they can be stocks, they can be anything. They could be the cost of purchasing a can of Coke at the grocery store. And so asset prices are going to go up. The cost of everything is going to go up. But because the governments are so indebted, which is the problem and the reason that the nominal cost of everything is going up in the first place, is they can't afford interest rates to go up or they're going to be insolvent. And so they're going to have to force interest rates to be low while asset prices reset up higher. And therefore, right to your point, that real rates of return are going to be negative on bonds. It will be. They have to keep interest rates low, and inflation is going to be higher than normal.
In the face of what we're talking about here, some people, a number, are predicting that the trend would be then for continued inflation of all assets, this bubble of everything we've been talking about. And I think Michael Pinto, we've had him on from Pinto Portfolio Strategies, he's talked about never before in history have we seen stock market and bond market and real estate market all simultaneously in a bubble. So there's no other asset that's negatively correlated to all of these bubbles than, for example, precious metals. But the question that some people are leading to is how long does and I know you guys have been asked this many times, is how long does this cycle just keep on, this bubble just keep on inflating? I think it's already, by many people's estimations, gone on much longer than many thought possible. And yet we now have, with yield curve control and other things, it seems like more and more ways of getting bridles on this beast and just to keep nature from taking its course. We have a question from Joey Santoro who says, please comment on Harry Dent's latest prediction, market crash in the next few weeks with gold crashing as well. So there's really two questions buried in there. One is, how long can this party go on that we've described as straining many bounds? But secondly, when a collapse of the equity markets does happen, or a major reset of the equity markets, will it mean that metals will fall with them and the stocks of mining companies as well? So let's take those as two questions. First, could we ask that one, how long do we believe this, and maybe not in terms of months or years, but mile markers and real meaningful relationships between things that this bubble can keep inflating without a major convulsive retraction? Rick, maybe you want to try that first?
I think it's human nature not to want to take personal responsibility for your financials. People want to believe that Trudeau and Biden and Yellen and all these people are responsible for their future. We've been in a very benign economic climate for 40 years, and confidence is very high, despite the fact that the arithmetic is very bad. So until the question arithmetically gets called, I suspect that things can go on. I've been one who has been, as a lender, more fond of arithmetic than narrative, and the consequence of that is that I have been consistently too cautious about the ability of the Fed to use counterfeiting and artificially low interest rates to prop up the economy. I'm cognizant too, being born in Silicon Valley and being a Californian by culture, to know the bull case, which is to say that our individual initiative, our individual creativity, our individual hard work generates so much value for mankind that we normally can overcome our collective stupidity. 6 kids get together in a garage and out pops Google, which earns a couple $2 billion a quarter on no capital investment. So things are getting better individually. So I guess maybe you need to think about when you have a collision between the narrative of individual accomplishment and the arithmetic of collective stupidity. And I really don't know when that happens. And I'll digress briefly to the Dent question before I cede to my young friend. Harry is I would say, a friend of mine, and he takes the point of view that they won't be able to inflate their way out of the debt, that will in fact have an honest default. Between Harry and I, because we both look at the economic circumstance through arithmetic rather than narrative, I would say that Harry and I, between us, have called absolutely accurately 30 of the last 3 declines. And so I would caution anybody not to listen too carefully to us about the timing of black swan events. I'm not merely disparaging Harry, I'm disparaging myself in the same breath.
There's one thing I've learned in economics is never, ever underestimate the ability of self-serving governments to kick problems down the road instead of solve them. I mean, this problem has fundamentally come about because the governments of the world have run unsustainable deficits and have built up unrepayable debts, and they are trying to monetize those debts. So if the question is, when is this problem going to stop? When are governments going to stop spending more money than they take in revenue? When are they going to stop printing new dollars? It could go on for a really long period of time. They could keep interest rates very, very low for the rest of my career.
So what about the second part of the question of, is there a reason to expect that should the market decline sharply, that mining stocks, even though they're literally sitting on a gold mine, or precious metals, which are fundamentally have intrinsic value and are not propped up by all this fluff, will sharply decline with them? And if people are, Rick, in the past, you've talked about people maintaining dollar liquidity, maintaining bullion liquidity, so that they could take advantage of situations and not be taken advantage of. Is that still what people are reasonable to be preparing themselves for? That should there be a major correction, all things will fall together, and that'll be a time to pick out some real values?
I don't think that you can time anomalous events. In other words, black swans, by their nature, are things that we can't foresee. I do think that people need to maintain liquidity, even though their liquid cash is declining in purchasing power. I call the negative interest yield an option premium, so that if the circumstance that I'm afraid of comes to pass, you will have, with the cash, both the tools and hopefully the courage to take advantage of the circumstance rather than to be taken advantage of. As to the prior question, which is to say mining stocks in a crash, my experience going back to 87 and then the tech wreck of 2000 and then 2008 is that in the near term, mining stocks are stocks. When the sector goes off a bridge, the mining stock go with them. And in fact, the small mining stocks, which is to say the most volatile, the most marginal assets, fall the furthest. The policy response to a crash has always been, in my career, add more liquidity and debase the currency, which means that the mining stocks, particularly those that are real ones, not amalgams of butchers, bakers, and candlestick makers around some piece of goat pasture, but rather the real mining companies come back much more quickly than the rest of the economy does, simply because the policy prescription for a crash is the debasement of the currency, which is, of course, good for precious metals.
I would echo that. In my career and based on my experience, I'm not expecting in this environment any massive exogenous shock that would cause a massive crash in the short term. But as Rick said, black swan events not only can happen, they do happen. And so to defend against that, the way that I've always run Sandstorm is with a stronger than average balance sheet. What you do find is when there are large crashes, that some companies, their stories become fundamentally and permanently broken because of the crash. And some companies just have a blip. Their stock price goes down, the fundamentals are strong, the balance sheet is strong, things come back up, and they're stronger than they ever were once everything resets. And so you have to differentiate as an investor, what kind of company are you investing in? Are you investing in a story that if you are wrong about the economy and there isn't a crash, that story is going to break? Or is that story going to it'll ride the wave and it'll come out the other side stronger than ever?
I would argue that for both Nolan and I, difficult times are beneficial. We are both providers of capital, and a circumstance where capital is hard to come by and expensive benefit check writers. At our heart, despite the fact that our approaches are different, both Nolan and I are check writers. So a circumstance where the combined market capitalizations of mining companies around the world fell by half would be followed by 18 or 20 months of absolutely perfect conditions for both Nolan and I to deploy, which would result after that in 5 or 6 very, very good years.
Mm-hmm.
Yeah, we've actually experienced that in the past. The last time gold got hit really hard, and base metals for that matter, was kind of around 2014, 2015, sort of at the bottom of the cycle. And I remember there was one company that was selling everything that wasn't bolted to the floor, and they sold us a portfolio of royalties. We paid, I think, $17 million US for that portfolio of royalties. And once the key mines are up and running here over the next number of years, I would expect to get about $25 million of free cash flow from that portfolio every year for decades.
That's a nice acquisition. We've been talking about difficult times and the unexpected results it can bring, but if you position yourself well, it can be fruitful. Jeff Barber asks, this is a question for starting out for Nolan, but it'll be for everyone, and that's about jurisdictional risk in these times. These times, they are a changing, and we've seen a lot more restrictions and upsets and that kind of thing that people couldn't necessarily have predicted in the past year that have affected us in many ways. Jeff says, would you ask Nolan if he can comment on country-specific risks? For example, President Erdogan's actions in Turkey. So, but broadening out to the general company-specific risks and how Sandstorm addresses that reality.
Yeah, I think there's really 2 parts to dealing with risk. One is, and we benefit from this as a royalty company, is you diversify as much as possible. Never underestimate the possibility of any government in any country, including Canada, from going temporarily insane for a period of time and it being a particularly disadvantageous place to do business. And so where you can diversify, do that. And that's how we run Sandstorm. We've got investments all over the world. And then I would say your second layer of defense from political risk after diversification is just understanding the nature of the types of risks in that country that are disproportional. And so, for example, in some countries like Canada, the risk is permitting. The risk is that you're trying to build a pipeline and you try for 30 years to build a pipeline and it never gets built because you can't get it permitted. In other jurisdictions, the risk is crazy governments trying to tax mining to death and effectively shutting down the industry. You look at countries like Argentina that not only tax mining to death, but then put currency controls in place to make it challenging for anyone to want to invest new money in Argentina. We have a couple small deals in Argentina, and we actually structured them with our counterparties, our multi-billion-dollar counterparties with mines all over the world. We structured our Argentinian deals outside of Argentina, so we're not subject to. There's no cash transacting in Argentina. We don't pay tax there, and we're not subject to any other currency controls. So we've mitigated that risk in that particular instance. Now, I would never want to put a large portion of our portfolio in Argentina because there's just too much total risk there. But so you diversify, then you figure out what the specific country risk is, and you try to mitigate it. And so part of the question was about Turkey. So we have an investment in Turkey called Hodmanen. And one of the challenges in Turkey is that they are very protective of their own economy. It's hard to do business there if you are a Canadian as opposed to a Turkish company. And so fortunately, all we own is a contract there, and it's a Turkish company that's actually moving forward the mine and building the mine, and they're very politically savvy and know how to get permits and how to do the things you need to do in Turkey. And so we're removed from that risk. We're not a Canadian mining company trying to go get permits as a Canadian mining company in Turkey. We don't have to deal with that. So my philosophy is diversify, and then beyond that, mitigate the risk wherever you can.
Rick, any thoughts from you on how country-specific risk, as you look around the world, not only are the world changing, but the times are changing, and those two are happening at the same time. So what are you seeing?
Dunnigan, I said on your show before that I think all jurisdictions are bad. The job of government is to redistribute, which suggests that they first have to steal before they can give. And a capital-intensive fixed asset like a mine is very, very, very attractive. If the 3 of us owned a freighter and the jurisdiction that we in became unpleasant, we could sail the thing out of port. When you have a mine, it's pretty fixed. So it's a wonderful target for government, besides which mines are ugly. So you have a jurisdiction like the People's Republic of British Columbia that charges as much by way of fees and taxes on mining as they possibly can and uses the money to subsidize the motion picture industry. My own worst experience with political risk was in my home state, California, with the permitting and the bribes. Oh, pardon me. I mean, campaign contributions and deeds in lieu associated with the Castle Mountain mine, a 13-year hiatus with $16 million in payments that had nothing to do with the export of deleterious materials from the mine site. So when I hear discussions about political risk in places like Congo or Turkey, and I think about my experience in my home state or my adopted province, British Columbia, I think all jurisdictions are lousy. What Nolan says about expecting the worst and trying to structure your transaction to anticipate the worst, and also diversifying your risk is the only alternative that you have. One final comment, Nolan mentioned their partners in Turkey, Çelik. I would do business with those guys in a conflict zone. I've come to know them fairly well. We were the second largest shareholder of that company when Nolan took it over. And we got to know the Turkish counterparties extremely well. The best mitigation for risk in cultures that you're not involved with are having mutually beneficial relationships with parties that can deal with various aspects of the risk that you can't.
Interesting. You guys have both looked at that in such experiential depth from different dimensions and different types of relationships that you've been in. It's very enlightening. We wanted to talk to you briefly, if we could, about the effect of the silver and gold spot price set on the COMEX and how that has affected the health of companies like mining companies, royalty and streaming companies. There's been lots and lots of talk about whether the price of these commodities or these precious metals, gold and silver, is natural, rational, or whether this is distorted and is, achieving some other ulterior agenda. How has the price of metals on the exchanges affected the health, the financial health of companies that are involved in the mining and of the industries that support it? Maybe Nolan, if you want to take a first crack at that. And let us know. I mean, our people used to say a few years ago, back when you said December 2015 was the low point, that it's like, oh, we're below the cost of mining. How can these companies even keep operating and so on? Has that been true? Have some of these times been so difficult that people have had to operate at a loss?
Absolutely, yes. It's an incredibly capital intensive business, and if you think about a mine as an entity that may have 1,000 employees, and you're situated somewhere, pick a jurisdiction, somewhere tropical in Africa, and it's hot and it's humid, and you shut that mine down and you send 1,000 people away, they scatter to all corners of the country, and your mining equipment is going to rust throughout within 1 year. So you shut that mine down, it's going to cost you hundreds of millions of dollars in working capital, in maintenance and other capital to fix your mine back up and running. And so the amount of money you're going to lose by shutting it down and then trying to restart it later when commodity prices are higher is substantially more than if you just operated at a loss. So mines have and do operate at losses during the downtimes. It's another reason why I love running a royalty company is if a mine is operating and they give us our gold, we sell it and we make a profit. There's no scenario where we're losing money because commodity prices have fallen below some certain key number. And so I think that's something that I particularly love about our industry. But what I will say, one quick thing, you started talking about whether commodity prices are manipulated and the trading and COMEX and all those types of things. I would say that, so I've recently been added to the board of the World Gold Forum. And I would say that it's very much on our attention and on our radar, understanding and changing how gold is traded around the world. And I would say, stay tuned over the next number of years because I think you're going to see a lot of structural changes that way. Actually,
I'm not against talking about it. I just didn't want you guys to feel put on because I hadn't warned you that we were going to. So that's fine. I'm happy for any insight that you have in that arena.
Yep.
Rick, your thoughts on the price of gold or silver that has been prevailing over the past decade and its effect on the industry?
Clearly there was a period in time when the gold price was low enough that even if the industry reported profits, the profits that they reported probably didn't properly take into account depletion. I remember in 2014, 2015, looking at the income statements of some companies that will remain nameless while I'm still licensed, and noting that the mined grade during the reporting period was substantially higher than the average reserve grade. But the depletion and depreciation that were reported on a unit of production basis, which is to say they paid depreciation charges based on tons, but they reported. Now, there's a phrase in this for the industry. It's called high grading. And high grading is okay if you report it properly. But I would suggest that there was a period when many companies impaired their ability to produce over time and impaired their producing properties to generate financial results, which resulted in a higher share price and a lower cost of capital as a consequence of that. Mercifully, I've been in the racket for 45 years. And I pay attention, like Nolan does, to the intricacies of financial statements and balance sheets. Certainly, this gold price is healthy, but what's healthier for the mining industry is that all of the bad decisions, or most of the bad decisions that management made in the decade between 2000 and 2010, resulted in probably 70% of the CEOs of those companies being thanked and excused, allowed to pursue other employment opportunities. And the consequence of that is that the mining company managements that you see thus far in boom times, which we're in now, aren't resulting in the same stupid capital allocation decisions that we saw in the last decade. I actually think that the management decisions are more responsible for improved balance sheets and income statements than the gold price. Nolan may disagree with me, but if you look back to the decade between 2000 and 2010, the gold price went from what, $250 an ounce to $1,400 or $1,500 an ounce before peaking at $1,900. And per share cash flow across the XAU declined. It takes real skill to blow a six-fold increase in the selling price of your product. And let's just say it impaired the reputation for financial excellence that the mining industry aspired to. The consequence of that is that investor expectations around mining right now are extremely low. And it's easy to exceed low expectations. And it's exceeding low expectations that cause market rebounds. So I think that we're in a healthy circumstance. Partially, yes, because of the commodity price, but more importantly, because of market-based reform inside the mining industry.
I've definitely seen evidence of that. As to your point, 75% of CEOs get fired. The next crop of CEOs aren't quite as bold as the last crop. What I would say is the 25% of CEOs that survived, they're amongst the most conservative. They know they just barely survived that clean out at the bottom of the last market. But I would be careful to differentiate between management teams and CEOs who are the new CEOs, and they were well experienced in their old role before becoming a CEO. So they were there when their boss got fired and they remembered those mistakes and they're not going to make those same mistakes. Versus I have seen behavior of some really young management teams who they just weren't even around. They're too young to have been around at the bottom of the last market. And I'm seeing them be committing some of the sins of the past. So we'll see how that plays out.
I wanted to take a moment because Rick, you've sent out an announcement about a partial retirement. You're narrowing down the focus of some of the activities that you'll be taking on, and just to give you a minute to let people know what it is you're going to be continuing and focusing on going forward, so they know if they want to find their beloved Rick, where they're going to find you.
Well, a few things have happened. As you suggest, I'm 68 years of age now. I've been very lucky. I've worked very hard. I've made a lot of friends. And I just sort of decided that I was going to do a lot less of the things that caused me aggravation and a lot more of the things that caused me joy. Retirement wouldn't work for me. It would kill me. so I'm not going to do that. But I'm resigning all regulated activities at Sprott, which is to say I'm going to give up my stock brokerage license and stuff like that. I'm no longer going to have my behavior constrained by FINRA. It'll be constrained by morality, which I think is a better constraint. I'm also giving up all the managerial and administrative roles at Sprott, with the exception of the fact that as the largest shareholder of Sprott, and by the way, the largest private client of Sprott, I'll maintain my role on the board of directors. I made a pledge at the annual meeting of Sprott in 2013 to all constituencies, shareholders, employees, and clients, that I would stay and build the business and safeguard the business through the bear market. I believe I've discharged that duty. And I believe, too, that my wife, who supported me through all that period, deserves more time and attention. I said in the letter that you referred to that I look forward to taking her on trips that didn't include a conference or a mine tour. And I still intend that to be true. I'm also taking the business out of Sprott that is known as Sprott US Media, and it will be rebranded Rule Investment Media. I'm not really sure what I'll do with it, but I'm sure that I'll have more fun with it, unconstrained by FINRA.
Interesting. Thank you so much for your membership among our viewers here. They always have looked forward to and learned so much from. I've heard more people talk about listening to your interviews multiple times. You're among that cadre of our guests that people want to listen to over and over again, so that they can try to get some of the marrow out of the depth that you bring to it. And so thank you always for your participation here and your leadership. And again, want to give you an opportunity before we wrap to invite people, if you want to have their portfolios ranked.
Delighted to. I love to engage in conversations with your viewers, Dunnigan. And the easiest way to do that is to start a conversation around something they're interested in, which is always their net worth and their portfolio. If you go to a website, sprottusa.com, yes, I'll still get it, sprottusa.com/rankings, and enter your natural resource stocks, including Sandstorm, one of my highest rated stocks, by the way. I will rank your portfolio 1 to 10, 1 being best, 10 being worst, and I will comment on individual issues where I think my comments might have value. In addition, in the question and comment section, if you include the word charts, I will include a copy of the Barron's Gold Mining Index, the longest running and most inclusive, gold equities index that I'm aware of, and a 100-year commodity chart, which puts into context the real pricing of commodities relative to other asset classes going back 100 years. And thank you, Dunnigan, for giving me the opportunity to address an audience that you've gone to some pains to gather. It's fun to interact with you in front of your audience, and it's particularly fun because I didn't have to do all the work to gather them.
Well, I think that's one of the examples of synergy. I mean, I think we talked about synergy way back at the beginning of this hour. Nolan, you started talking about how royalty and streaming companies have a synergistic relationship with the underlying operating companies. And here's another example of that synergy. The three of us are all here trying to get awareness out, build understanding, knowledge, and the folks who are watching, our viewers, are benefiting tremendously from that. They look forward to these times. And so thank you, Rick. And Nolan, I just wanted to give you a chance to remind everyone, first of all, if you could just take 1 minute to tell us what got you involved in this whole treasure hunting business in the first place. And then secondly, how people can find out more about Sandstorm.
Yeah, so I got into the mining space about 20 years ago, right after I graduated university. In fact, I remember first time being invited down to the Vancouver Convention Center for a mining conference. And I said, that doesn't sound very fun. I don't want to hear a bunch of guys talk about mining. And one of the guys in the office is like, oh, there's this guy, Rick Rule. He's like worth talking. He's worth listening to. You should come down, just listen to him and then go back. And I actually did. And I was like, yeah, I like listening to this Rick guy. He's a pretty smart guy. And so I just fell in love with the mining industry, just traveling the world and seeing the building blocks of the world get pulled out of the earth. It's a fun business to be a part of. And I've fallen in love with it, and I'm going to be doing it for the rest of my career. And Sandstorm is a company, it's a passion project of mine, and I think we've added a lot of shareholder value. We're going to continue to add a lot of shareholder value, and so plan on running it for a long period of time. I wish I was on the precipice of a Rick's situation and giving my wife more time and trips that don't involve mine tours and conference centers, but I think I'm going to be in this game for quite a while. And so for those who want to know more about Sandstorm, they can just go to our website. It's sandstormgold.com.
All right. And folks, so that you can stay in touch with us and all of our guests, not only Rick and Nolan and all the other guests we have, and any resources and links that they provide, make sure you sign up for our free newsletter at libertyandfinance.com. Just put your name and email address in there, and then confirm. When you get the confirmation email back, you'll be on our free mailing list 3 times a week. All of our interviews will be in there for make sure you don't miss us. And if we do broaden out, which we are beyond YouTube, to Brighteon and Rumble, you'll get information on that as well. So Rick Rule, Director of Sprott, Nolan Watson, President and CEO of Sandstorm Gold Royalties. Thank you both very much for having this time together here on Liberty and Finance.
Thank you, Dunnigan. Thank you, Nolan.
Yeah, thank you, guys.